Please write an answer for A double I. In that, write down calculation of cost of preference share. In bracket I'm writing KP. In that, write down assuming that preference share is issued forever, comma, KP is calculated. Full stop. So the amount of the preference dividend is 1 rupee 10 paise, and issue price of the security is 9 rupee 20 paise. So taking both of them into account, we'll calculate the KP. So cost of preference share is preference dividend divided by amount. It is 1 rupee 10 paise divided by 9.20. That is the way we'll make the calculation of the cost of preference share. We know that there is no point of the income tax to be considered right now. Why? Because it is not an allowable expense from tax point of view. So it is 1.1 divided by 9.2. That comes to 11.96. Please write an answer. The next question is, we are required to calculate the cost of new equity share, assuming new equity from retained earning. So the question says that you are required to calculate the cost of retained earning. See, the language of the question says that assuming that the new equity from the retained earning. It means that you are required to compute the cost of capital, considering that you are going to have the retained earning as a source of finance. Now, dear students, we have been provided with the information about the dividend. You can see that the question is providing the information about the dividend like this, that next year dividend will be 50% of 2022 earning per share, like that information is given. So it is say 1 rupee 80, that is 1 rupee 18 paise is D1, that is the first thing. Then market price of the share is provided to us as 23.6. Now importantly, we are required to compute the growth rate. Looking to the information we understand, we can compute the growth rate for 9 times. Why? Because the 10 years information is provided to us. So what we can do, dear students, let us understand that carefully. What we can do, we can make the calculation of the growth rate maybe for 4 years, 5 years, and we can take average of the same as the future expected growth rate. At the same time, so you can make the calculation of the growth rate calculation for a more number of years also. So randomly we are required to take the growth rate calculation for a certain number of years. Doing for growth rate calculation for 9 times is also acceptable. Since it is the only question that we are doing wherein so big information is given to us, so I am doing answer for 9 times, that is like computing the growth rate for 9 times. However, you may do it only for 4 to 5 years, that is the recent time period will be taken into account to make the calculation of the answer. So we'll compute the growth rate. D1 P0 is given to us in the question, and then cost of retained earning. So please write an answer. Heading right down. Calculation of KR, cost of retained earning. In the write down, working note number 1, calculation of growth rate. In bracket I am writing G. Column number 1 is year. Column number 2 is EPS. Third column is change in EPS. And the last column is growth rate. Year 2013, 14, 15, 16, 17, 18, 19, 20, 21 and 22. Earning per share is 1, then it is 1 rupee 10 paise. So change is 10 paise. And what would be the growth rate? 0.10 divided by 1 into 100. That comes to 10 percentage. Next year it is 1 rupee 21 paise. So there is a change by 11 paise. Okay, 1.21 minus 1.1. So it is 11 paise divided by 1.1 into 100. That comes to again 10 percentage. Next is 1 rupee 33 paise. So 1.33 minus 1.21. That comes to 12 paise. So 12 paise divided by 1.21 into 100. So 0.12 divided by 1.21 into 100. That comes to 9.92 percentage. And so on, we are required to compute the change, and based on that, the growth rate. Then whatever the growth rate answers that say we compute, we'll make summation of the same and we'll do average. And whatever is the average, that is the rate at which the earning and dividend will grow in future. That assumption is made. Try to complete the answer on your own for the growth rate. Then put your answer in the chat box for the average growth rate. Next is 1.46. So 1.46 minus 1.33. That comes to 13 paise. 13 paise divided by 1.33 into 100. That comes to 9.77 percentage. Next is 1 rupee 61 paise. 1.61 minus 1.46. That comes to 15 paise. 0.15 divided by 1.46 into 100. That comes to 10.27 percentage. Next is 1 rupee 77 paise. That comes to 16 paise. 16 paise divided by 1.61 into 100. That comes to 9.94 percentage. Next is 1 rupee 95 paise. 1 rupee 95 paise minus 1 rupee 77 paise. That comes to 18 paise. 18 paise divided by 1.77 into 100. That comes to 10.17 percentage. Next is 2 rupee 15 paise. So it is 20 paise. 20 paise divided by 1.95 into 100. That comes to 10.26 percentage. Next is 2 rupee 36 paise. So 21 paise divided by 2.15 into 100. So 21 paise divided by 2.15 into 100 is 9.77 percentage. So this is the way we, 9.77 percentage. This is the way we compute. Now we are having the growth rate for 9 times. So it is 10 plus 10 plus 9.92 plus 9.77 plus 10.27 plus 9.94 plus 10.17 plus 10.26 plus 9.77. That comes to 90.10. So the total is 90.10 divided by 9. So we understand the average is 10.01 percentage. That is what we understand. It will be found as 90.10 divided by 9 years. Why? Because the growth rate is calculated for 9 times. Okay. It is 1, 2, 3, 4, 5, 6, 7, 8 and 9. So approximately the growth rate is 10 percentage. So we have computed the growth rate. It is like near to 10 percentage. Next is calculation of working note number 2. Calculation of D1. It will be found as earning per share of the year 2022 into dividend payout ratio. Earning per share of year 2022 is 2 rupee 36 paise into 0.5. That comes to 1 rupee 18 paise. That is the way the D1 is calculated. Next is calculation of K. It will be found as D1 upon P0 plus growth rate. D1 is 1 rupee 18 paise. P0 is 23.6 plus growth rate is 10 percentage, 0.1001. So 1.18 divided by P0 is 23.6, that is 0.05, 0.1001. That comes to 0.1501. That is 15.01 percentage. Or you may write say the 15 percentage, that is also acceptable. This is the way cost of retained earning is calculated. Cost of retained earning. So we have computed the answer of A part of the question. Cost of new debt, that is I think 8.33. Cost of new preference share, I think that's it is 11.96. And cost of retained earning, it is 15.01. Okay. Now B part of the question. Calculate marginal or incremental or additional or differential cost of capital when no new shares are issued? That is a question. I request you to calculate answer of this question on your own and put your answer in the chat box. Dear students, over here, the question is providing the information that say the company has this as the optimum capital structure. What does it mean? It means that say the company is always financing the funds in this proportion only. So I request you to use a calculator. We understand that say the 30,000 rupees of the debentures out of 2 lakh rupees of the total capital. So 30,000 divided by 2 lakhs. We have to understand that so the debt financing is 15%. Preferential capital financing is 10,000 out of 2 lakhs. So it comes to 5%. And so the equity shares of 160 out of 2 lakhs, that comes to 80%. So we have been provided with the information that say these are the proportion of the each source of finance in the capital structure. We have to understand that so the company is always having so the financing in this pattern: 15%, 5%, and 80%. The second important thing, friends, is that say we already have that say what is the cost of individual source of finance. So taking into account one, cost of the individual source of finance, which we have calculated in the A part of the question, and say the proportion of the each source of the financing in the capital structure, will compute the weighted average, and this is what say we understand is the weighted average or marginal cost of capital of the company when there is no new financing, new equity share capital financing. I request all of you to write down answer along with me for the B part of the question. In that write down, over here we have to understand that we have to compute weighted average cost of capital or marginal cost of capital, comma, when there is no new issue of equity share capital. Full stop. Importantly, present capital structure is provided in the question, comma, it is optimum, full stop. So we will compute proportion in which company will company raises finance, and with that WACC will be calculated. Full stop. In that write down working note number 1, calculation of weight of individual source of finance. In that write down column number 1, source of finance, column number 2, amount, column number 3, weight. It is debentures, amount is 30,000, its weight will be 0.15, that is 30,000 divided by 2 lakhs. Next will be preferential capital. In that, so the amount will be 10,000, weight will be 0.05, 10,000 divided by 2 lakhs, that comes to 0.05, and the last is equity shares. In that case, it is 1,60,000, then it is 0.8, so 1,60,000 divided by 2 lakhs. This is the way we'll have the weight of individual source of finance in the capital structure. Afterwards, cost has already been found by us. We'll compute the weighted average. Yeah, total of all of them will always be 1. Okay. Next, calculation of WACC. In that, weight of debt financing into cost of debt financing plus weight of preferential capital into cost of preferential capital plus weight of equity into cost of equity. What is the weight of debt financing? It is 0.15, multiplying with the cost is 8.33. Weight of the preferential capital source of finance is 5%, multiplying with the cost is 11.96. Weight of equity is 0.8 into cost of equity is 15.01. That is the way we are required to calculate the answer. So over here 0.15 into 8.33, it is 1.2495, so I am taking 1.25 plus 0.05 into 11.96, that is 0.5980, so I take 0.60 plus it is 12, so 12 plus 1 13, 13.85%. So till the time the company is issuing new equity shares, the company is required to earn at least at the rate of 13.85% from the project. I want somebody of you to answer the question in the chat box. How much can be spent for capital investment before new ordinary shares must be sold. Assuming that the retained earning for the next year's investment are 50% of 2022 earning. Okay, earning is not printed, but this is what we have to understand. There is no lacking of the printing. I just explained that to you. That's the question says that how much can be spent for capital investment before new equity shares must be sold, assuming that the retained earning for the next year investment are 50% of 2022 earning. Please calculate answer. Dear students, over here the question is providing the information that the company has issued 10,000 equity shares. Earning per share is 2 rupee 36 paise of 2022. Half is paid in form of dividend, so the remaining half is retained. So we understand that there are 10,000 equity shares and 1 rupee 18 paise is retained in the business. So it comes to 11,800. The question is providing the information. We are having the proportion of the equity financing 0.8. So what will happen? Amount of the retained earning divided by 0.8. So we understand that once the capital investment exceeds 14750, we are required to issue the new equity share capital. Let us answer the question. Amount of capital investment beyond which the company is required to issue new equity share capital. It will be calculated as retained earning divided by weight of equity. See, the company has issued 10,000 equity shares. Earning per share is 2 rupee 36 paise. And the company is going to retain 50% of the earning. So this number of equity shares into earning per share will give the total earning, into retention ratio will give the retained earning, divided by 0.8. So 23,600 into 0.5 divided by 0.8. So 23,600 into 0.5 divided by 0.8. That is 14750. I request all of you to write down answer. Next question. What will the marginal cost of capital when the funds exceeds the amount calculated in C, assuming new equity is issued at the rate of 20 rupees per share? I request you to do answer for this question and put your answer in the chat box. Dear students, we understand that over here the question says that once your capital investment of 14750 is exhausted, in a way that you already have made the capital investment of 14750. Beyond that, till that point of time we have to earn at least at the rate of 13.95%. which we have calculated above, 13.85, I'm sorry. So we have to earn at least at the rate of 13.85% till 14750. Now beyond that, say we are supposed to earn at the rate which is like supposed to be calculated over here. What will happen? Once retained earning is exhausted, then in that case you have to make the new issue of equity share. Dear students, we understand practically that say when you will issue the new equity share, then in that case it is supposed to be issued at slightly lower price. So instead of 23.6, you will be able to issue at some less price. Because basically what happens at say practically, you have to attract the investors that say they buy security from you. It is not that say they will be buying security from you unconditionally. If at all you keep the same price say which is there in the market, then in that case say they feel indifferent, and what is the purpose of buying from you? That is what say they feel. That is the reason say what they will do, say in order to attract them, you'll issue the security at slightly lower price. That is the first thing. The second thing that say we understand is say there will be some flotation cost, and deducting both of them from 23.6, basically we are going to get an amount of rupees 20. So what happens at say over here, say we are required to make the calculation of the answer like this. So the answer for the D part of the question, in that we will work out the answer in this way. I request all of you to write an answer. Calculation of marginal cost of capital, comma, when requirement of the funds exceed rupees 14750. Full stop. In that we will write working note number 1, calculation of cost of equity. It is D1 upon P0 minus flotation cost plus growth rate. D1 value is 1 rupee 18 paise. P0 minus flotation cost is 20 rupees. Plus growth rate is 0.1001. So it is 1.18 divided by P0 is say P0 minus flotation cost is 20, that is 0.059 plus 0.1001. So it is 0.1591. 0.059 plus 0.1001. So 0.1591. That is 15.91 percentage. This is the way the cost of equity is found. And lastly, we'll make the calculation of the weighted average cost of capital. Calculation of weighted average marginal cost of capital. The term marginal cost of capital means that whatever the funds that we require beyond 14750 will have this cost of capital. So in that we will have cost of debt into weight of debt, cost of preferential into weight of preferential, cost of equity into weight of equity. What is cost of debenture? It is 8.33. What is weight of debenture? It is 0.15. Cost of preferential is 11.96 into 0.05. Cost of equity is 15.91 into weight of equity is 0.8. This is the way we are required to compute the answer. So 8.33 into 0.15, that is 1.25. 11.96 into 0.05, that is 0.60, plus 15.91 into zero point 0.8, that is 12.73. So finally it is 1.25 plus 0.60 plus 12.73, that comes to 14.58 percentage. So for any requirement of the funds beyond 14750, this is the minimum rate at which we are supposed to earn. Let us have understanding that's of the entire question. Once again, a small revision. In the question number A1, the question says that you are required to compute the cost of new debt financing. So for that, we are using the formula interest into 1 minus t divided by amount. We assume that the face value is 100, and second, we assume that the security is issued for perpetuity. The second question says that the A that what is the cost of new preference share. In that case, again, simple formula, preference dividend divided by amount, 1.1 upon 9.20 into 100. And then we make the computation of the cost of retained earning. We have done very detailed working, wherein we have computed growth rate for 9 times. But doing for 9 times is really not required. If at all you take like the 4 or 5 years is also acceptable. Suppose you are doing it for 5 years. Just I'm taking an assumed value 5 years. Then it is 10.27 plus 9.94 plus 10.17 plus 10.26 plus 9.77. So the total is 50.41 divided by 5. That comes to 10.08. So you can see that it is not going to have a huge difference if at all you take the 4 or 5 years value. So we have computed the growth rate. Then earning per share of the next year is 2.36 rupee. Of that 50% is the dividend. Then calculation of the cost of retained earning using the simple formula D1 upon P0 plus growth rate. At this point of time, you have not been given the flotation cost information deliberately. Why? Because you're required to compute the cost of retained earning. Language of the question clearly specifies that you're required to compute the cost as if we are not going for any new issue. B part of the question, in that we are required to compute the weighted average cost of capital. In that, dear students, we always make an assumption that whatever the existing capital structure that we have, the same capital structure we will continue in future. So we have computed the proportion in which we raise the funds, multiplied with the respective cost of capital is the weighted average cost of capital. Means till the time we use retained earning as a source of the finance as the equity component, then in that case we have to earn at least at the rate of 13.85%. This is what we understand. The question says further that what is the amount of the capital investment that you can make before the new issue is required to be made. It is retained earning upon weight of equity. Amount of the retained earning is 11,800 divided by 0.8. So beyond this, you have to issue the new equity share capital. Then weighted average cost of capital when the funds requirement exceeds this. So in that, first of all, we compute the cost of equity. In that, the flotation cost will be deducted. We have been provided at this point of time. See, the sequence in which the information is given is excellent. At this point of time, we have been provided that the new equity share issue will have the price of 20. Accordingly, the KE is calculated, and lastly, weighted average marginal cost of capital. So when funds requirement is exceeding 14750, we have to earn at least at the rate of 14.58%.